Hi folks, and welcome to this short review on share dividends. Let's do a quick review of the topic just to reinforce in your minds what you need to remember. So the last time we met, we did discuss share dividends, and what we said is it's a type of dividend which does decrease retained earnings because all dividends are declared out of retained earnings, whether they're share or cash dividends. But in this case, because we're going to be giving shares to our shareholders as opposed to cash for the dividend, it's not paid in cash, but we are issuing new or additional shares instead of the cash. So we talked in class about what the journal entry would look like when we are issuing a share dividend at a date different than the declaration date. So new shares are going to be issued. So we're going to increase the number of shares that are issued and outstanding when we issue the share dividend. When we declare the share dividend, if we declare it on a date that's different than the date we issue the new shares, we're going to debit an account called share dividends, or again, you can debit retained earnings directly for the value of the share dividend, and we're going to credit a new account that we learned. It's also a shareholders' equity account, and that's called common share dividends distributable. And note, this account, common share dividends distributable, is a shareholders' equity account, not a liability account. Now, when it gets to the point that we are going to issue the dividends, what we do to distribute or to issue the shares associated with the share dividend, we're going to debit or reduce this common share dividends distributable account and credit common shares. Notice that in neither of these entries, the declaration or the issue of common shares, we do not use cash at all when issuing the shares, because we're not paying cash. The other thing you'll notice that we discussed in our class is that in each of entries number 2 over here and number 3 here, since a shareholder's equity account is debited and credited in each entry, so if you look at the declaration entry, we have retained earnings or share dividends. Both are shareholders' equity accounts. Okay, retained earnings is going to go down because we would debit it when we close out the share dividends, and this account, share dividends distributable, it would go up because it's credited. So a debit and a credit to shareholders' equity leaves shareholders' equity totally in balance. So there's no net change in your total shareholders' equity. Similarly here, we have the dividends distributable account going down when we issue the shares, and the common share account, which is part of equity, going up. Because they're one's going down and one's going up in the same amount, we note again that total shareholders' equity is not affected. So what this means is that the total shareholders' equity remains the same before and after the share dividend. However, we will admit that the account balances in these 4 accounts will be changed. So let's take a look at a question and see if we can apply what we've reviewed here. In our example, let's say we have information taken from a company, Jamestown Corporation's balance sheet at April 1st, 2014. Now, what do we find? They have 375,000 common shares that they are authorized to issue and 150,000 shares that they've actually issued that are outstanding with shareholders. We see here that our total shareholders' equity is 1,735,000. The common shares, the amount of capital, or the amount of cash that the shareholders gave Jamestown for 150,000 shares was 1,102,500, and we have retained earnings of 633,000. So now, if we assume that on April the 1st, which is the date we're looking at the balance sheet, Jamestown decides after this sheet is prepared to declare and distribute a share dividend. The market value, which is going to help us determine the value of the share dividend, is $25. We want you to prepare the equity section of the balance sheet immediately following the share dividend. And assume here that all dividends are debited directly to retained earnings. So if you look up here, we're not going to use the share dividend account. This question is a little bit different that way. So what would happen in our solution? Well, if we looked at the equity section of the balance sheet just after the issue of the share dividends, so that might be better just to put it at April 2nd, all right, after the issuance of the shares, what do we see? We still have the same authorization limit. That hasn't changed. But notice now we have 165,000 shares issued and outstanding. When we were there the day before, we only had 150,000 shares issued and outstanding. Why is that? Well, don't forget, of the 150,000 shares that we had issued and outstanding before the share dividend, 10% are now being issued as new shares, which is 15,000 new shares. So 150,000, if we want to type it in here, plus your new 15,000 shares is going to give you 165,000 shares. And that's what we have here. Notice that the amount of paid-in capital here of 1,477,500 is also recalculated because we're issuing these shares. So what would happen when we issue the shares? What we said in our previous class was that we issue the shares, the new shares, based on their market value. So we take the 15,000 in new shares, multiply it by $25 a share, which is the market price of the shares at declaration date. All right? And then we're going to get $375,000 of new equity. So therefore, to calculate this number here, we're going to take 1,102,500, which is what we started with over here, just before the share dividend. And we're going to add to it the value of the share dividend based on the market value of the shares at declaration date. And that's going to give you 1,477,500. Now, what would happen to retained earnings? You can see that we have a different balance in retained earnings here than we had initially in our question. Why is that? Well, it would be a good idea to recall the entry that we would make when we declare and issue the share dividend on the same date. We would debit retained earnings, and again, they did tell us to debit the share dividend directly to retained earnings, and we would credit common shares because the share dividend is declared and issued on the same date according to this question. So therefore, what would we do? Okay, what we would do is we would debit retained earnings, credit common shares, all right? And when we debit retained earnings, we take the balance from 633, we lower it by 375 because of the debit to retained earnings here to get a final balance in retained earnings of 258,000. Now you'll notice here that the total equity is still 1,735,500, which is the same as it was, oops, made a little typo here, which is the same as it was in the question when we began, right? Before the share dividend. So as we said before, the total shareholders' equity remains the same before and after the share dividend, but the account balances in the equity section do change. So we do have a different balance after the share dividend is declared and issued in our common shares, and we do have a different balance in retained earnings from what we started with. And that should be evident to you from this question. So now, if you would like more practice, why don't you go back to your handout, which you've probably printed or have on your screen for this video, and check your eLearn course because there is another video on this topic that may help you. So this concludes our review of share dividends.